He has successfully guided 3 PhD candidates, and 5 candidates have been pursuing PhD under his at present. So with this word, I am requesting Professor Goel to take charge of this session. So over to Professor Goel and say a few words in this regard. Over to Professor Goel.
Is he muted?
Professor Goel, can you hear us?
Sir, you are muted. Professor Goel, you are muted.
Actually, he has joined in 2 different, that's why there is some problem.
Oh, yeah.
2 different views you can see.
No, please give him some time.
Okay.
He will join. No problem. He will join. Maybe some connectivity issue now. Now, sir, please unmute yourself. Your one device is enough. Please unmute, sir.
Good afternoon, everyone.
Yes, yes.
Yes.
We can hear
Good
you.
afternoon.
We can hear you.
Am I audible now?
Yes,
Yes, sir. Yes.
Thank you, sir. Sorry, there was technical glitch, and now the things are okay, I think.
It's okay.
So, thank you, Professor Amitabha, for nice introduction of myself. I don't know where you got these informations, but thank you for introducing me. So, we are starting this technical session, 3rd. I think this is the last technical session, but last but not least, because we are considering the organized sector in this particular session. This is on economic and business challenges in organized sector, pandemic and after. So on this session, I welcome all the dignitaries on this virtual platform.
Professor Goel, we can't hear you.
Again, connectivity issue.
Connectivity issue.
Sorry, again on the, so I welcome you all dignitaries on this virtual platform. Professor Arindam Gupta, Professor Arindam Das, Professor, my friend, Professor Ram Prahlad Chaudhary as keynote speaker, Professor Amitabha Gupta, Professor Dr. Devvrat Jana, and my friend, Professor Kajar Barjan Jana, all other dignitaries who have joined us. I welcome you, all the delegates, guests, and participants.
It's getting disconnected.
I think we request to switch off the video. Otherwise, there might be a local network issue. Okay. Yes, sir.
Sorry, today weather is, I think, the issue, and
it's okay.
We are again
It's all right. It's all right.
It's all right.
Without wasting time, in case I get disconnected, in my absence, Professor Arindam Das will continue and take over the charge for the further proceedings in case any discontinuation of this technical problem or technical glitch.
Okay, sir. Okay, sir.
So on behalf of this, myself and organizing committee, I welcome you all, and without any break, I invite Professor Ram Prahlad Chaudhary to deliberations to deliver his keynote speech. I'm not sure because the technical problems are there. Slowly, gradually, the things will be normal. So Professor Chaudhary is my good friend. He's very dynamic, he's energetic, intellectual, and very intelligent. We met many at many academic platforms. So I'm sure he'll be the right person to initiate the things and thoughts. I think I'm the only non-technical person in this technical session because chairperson is always a non-technical, but it's a coincidence. I'm a student of business economics and finance. So this is the topic is my area, and maybe Professor Arindam Gupta has invited me due to my field. So I invite with all respect Professor Ram Chaudhary. Professor Ram, please continue with your keynote speech.
Okay. Thank you, sir. Thank you, Krishna ji. Many, many thanks. Honorable Chairman of today's this third technical session, Professor Krishna Avtar Goyal ji, the Senior Professor of Jai Narayan Vyas University of Jodhpur, Professor Arindam Gupta ji, the Professor of Commerce in Vidyasagar University, Professor Arindam Das ji of Bardhaman University, Professor Devabrato Jana ji of Bankura Sammilani College, Professor Amitabha Gupta ji of SWAMI Vivekananda Institute of Management and Computer Science, my teacher, Professor Sudipti Banerjee, who is present virtually with us, all the paper presenters, many of my teachers, my mentor, my fellow friends, and participants of this international webinar. As we all know that we are going to discuss in this session on the economic and business challenges in organized sector, pandemic and after. Now, let me very briefly, as I have been allotted almost half an hour, so I will try to confine myself within the time. So very quickly, let me start with this, that nothing is permanent in this world. Everything is going to be changed. So that this novel COVID-19 pandemic is also not going to sustain forever in our civilization. So with this change, the state of pandemic COVID-19 is also going to be changed very soon as we will be having the vaccine. But during this period, what it has harmed the humanity at large across the globe, that about 3 crores people have been affected with the coronavirus disease. In India itself, more than 5 million people have been affected, if I will look upon the today's current data. And so far as 82,000 deaths have been reported. And if you will take the total death of the globe, then it is nearby 1 million. Why I am talking about these figures? Because only 20-25 days back, when we were discussing on this tele, then we found that India was on 3rd position. But today we are noticing India is on 2nd position with the reported number of coronavirus cases, more than 50 lakhs. And in a very near future, we suspect that if this daily adding of almost 1 lakh reported cases is going to be continued for a few more days, then we will even reach to the position of number 1 in terms of number of reported cases. And so far as concerned about the total reported number of deaths, presently we are in 3rd position, but even we may reach to the 2nd or 1st position. But with this sensitivity, we need to discuss on the impact of this pandemic on Indian economy. And I personally believe this financial emergency has arrived only after the independence. In independent India, we have never faced any situation like this. The core sector contracted about 38% in April only, just after 1 month of declaring the lockdown. And all 8 infrastructure sector, that is the coal, cement, steel, natural gas, refinery, crude oil, etc., all of them have been witnessed the contraction in itself. The cement production fell by 86%, and whereas the fertilizer and you can say crude oil, these were reported at the down production by 4.5% and 6.4%. So this was not only the infrastructure sector, but service sector, made with the aviation, tourism, or other international trade, were the worst affected during the lockdown period. Now, if we will look upon the wage payment, the data, just I am confining my data because CMIE data is a vast data. Last day, Professor Devasis Soors was also talking about this. So I'm not going to much in detail, but just only I am going to highlight the decrement in the wage payment. And we found that in more than 1,500 listed companies, the wage increment were reported at only 2.9% in the month of June 2020, and which is the lowest growth rate in last 18 years. Manufacturing companies has already 7% fall down in their total wage payment. Within the manufacturing, like labor intensive sectors, say for example, the textile industry, leather industry, automobile industry, in all 3 industries, almost there were the dip in the wage payment by 29%, 22.5%, and 18.6%. Even automobile ancillaries reported to pay the underpayment with 21%. So what we are observing, that the wage payment is drastically coming down during this lockdown period. In service sector, same declining trend has been reported with the wage bill in, say for example, tourism industry. I will be discussing on this tourism industry in a bit detail. So hotel and hospitality industry 20%, road transport almost 27%, education, where we all belong, education sector underpayment is 28%, and real estate underpayment by 21%. So only positive report were coming from the telecom sector, banking sector, and securities broking companies. There we noticed that 10% or 16% and 13% may jump on their wage payment. And if you will look upon the non-salaried form of employment have been increased from 317 million in 1920 to 325 million in July 2020 growth. So what we are observing, there were the loss of 17 million salaries job in the June quarter ending, and for the same period only 8 million job has been transformed from salary job to non-salary job. Now, day before yesterday, we have noticed that our union labor minister, Mr. Santosh Gangwar, reported in the parliament that 39,000 crores rupees have been withdrawn from the EPF, Employees Provident Fund, during April to August 2020. So what it proves? It proves that the people are simply encashing their lifelong saving for their survival. And among this 39,000 crores rupees, if you will set aside the figure of Karnataka, Maharashtra, and Tamil Nadu, then it comes to 20,000. That means about 19,000 crores rupees have been withdrawn only in these 3 states which were worst affected. Now, Indian economy cannot be discussed without touching upon the issue of the GDP growth rate. We are observing that the GDP growth rate is continuously and consistently coming down since 2016 onwards. Every year we are observing there is a negative or declinement in the GDP growth rate. In 17, it was 7.4%. which reduced by minus 92% almost. And in 18, we found it was 6.12%. In 19, 5.02%. Again, it was minus 1.10%. These were the annual changes I am talking about on the GDP. And in 2020, we observed 4.2% merely, which is again negative annual change, that is 0.82%. And if you will take this figure of first quarter of the 2021, then history or entire world knows about this development, almost about the minus 24% or like that. ICRA is also expecting contradiction in the GDP growth rate. But one positive thing I wish to share here is that is all about the direct tax revenue collection in the quarter one of the 2021, which is 80% of the first quarter of financial year 2019-20, that is 1920. Okay, so, and it is being reported that you see, we have collected the direct tax almost 80% in comparison to the first quarter of the last financial year, despite the fact that the corporate tax rate has been reduced from 30 to 22%. But sorry, my dear friend, I wish to submit my submission over here. This might be the reason that in formal sector, the employees, organized employees are paying a huge amount of TDS. There is the implementation of the 7th pay commission, 6th pay commission, and that may be the reason for the higher amount of realization of the TDS. And this may be the another reason for the maintaining the 80% of the quarterly collection of the direct tax revenue. Now regarding the GST collection, 32,000 crores rupees and 91,000 crores rupees have been collected in April and May respectively, and which is again lesser than the about 70% of the last year. So World Bank is also estimating. Now if we are going to simply check the fact, then we are observing that after 2007-8, that is the subprime crisis, our economy has not been affected due to the banking prudential norm. But what we are observing in the advancement, or you can say so many rampant reforms going on within the public sector undertaking as well as public sector banking in last 12 years, continuous decline in economy, and it has become the fashion to finance 4% by making a disposal of the public sector undertakings. So 2 times union government has already taken the fund from the RBI. Liquidity is become a very, very crucial issue. Prices of crude oil came to the record low level in the last 20 years. And vis-a-vis, we are noticing that unemployment is also surmounting to the highest level in last 40-45 years. If you will look upon the April 2020, then we observe the 26% unemployment in India. Almost 14 crores of Indians have lost their job. In urban area, 53% business has been stopped. So union government has suspended all MPs LAD fund, local area development fund, for next 2 years. Now migrant labor issue becomes a very, very serious problem in our economy. According to RBI financial stability report, bad loans are going to be rise, say for example, up to 14.7% in March 2021 in comparison to 8.5% in March 2020. So you see, 6 to 7% jump is going to be noticed. Now, if we will simply analyze some sectors, say for example, I will just 4 or 5 sectors I will be highlighting very briefly because we don't have much time. Manufacturing sector. So we all know that 20% of our GDP is coming from the manufacturing sector. And of this 20%, 50% is contributed by the automotive industry. Millions of daily wages workers who have left cities are not coming again because they are having a threat. They are having the perception that they again lockdown will be there and I will have to push back to my native place. So people have no money to buy the goods and services, and as they are at the home since last 4 or 5 months, and they are spending on buying only essential goods and services. So to raise the demand, the most difficult challenge for the manufacturers is in the post-lockdown, because the post-lockdown is also not going to witness the absolutely normal situation. Production is down by almost 50%. Demand is very weak in textile industry. So under the circumstances, the new normal is going to witness the new advancement in the technology. Maybe the, say, for example, 3D printing services, Internet of Things like artificial intelligence, robotics manufacturing. So all these are going to be the very, very popcorn in the new normal situation. Now, if we will talk about the opportunity, then I personally believe there is light at end of every tunnel. Every crisis brings its own opportunity, and India is not the exception. For decades now, our neighbor country, China, has been the factory of the world, which is accounting almost, you can say, 1/3 of the all product manufactured on this planet. So India has also tried in the past to boost this manufacturing sector by trying to pursue the foreign investment or by adopting some other reform measures. But what we are observing that we are not 100% successful in making India schemes. So opportunities are there. Why? Because the global pain of over-reliance on China has been already experienced by the rest of the globe. Japan has already announced the package of $2.2 billion to Japanese manufacturing sector to simply make their manufacturers self-reliant. Trade war situation is coming up. Cheap labor issue is there. And decline in working age population in China is the biggest opportunity for us. We are also having a cheap labor and China country has also the cheap labor. But where lies the difference? Difference is that we can deploy the cheap labor because we are having the working labor force more in comparison to the China. But challenges are also there. Rising competition from the peers countries. Say, for example, just one country I will be citing, Vietnam. Now, Vietnam is the fastest growing economies. And I believe that it can surpass the economies like Singapore, United Arab Emirates, and Hong Kong in the very near future. So all credit to its thriving manufacturing sector goes because they try to make their manufacturing units self-reliant. So pharmaceutical industry in our country is also very, very contributing in the GDP. India is the largest provider of generic drugs globally. There is no denial in this. And this sector supplies over 50% of the global demand for the various vaccines. 40% of the generic demands in the US and 25% of all medicines in the UK is being supplied by we the people. So Indian position in the global pharmaceutical sector is good as we have a large pool of scientists and engineers. Over 80% of the antiretroviral drugs, which is pertaining to the AIDS or HIV, etc., are supplied by the Indian pharmaceutical industries. So pharmaceutical export from India stood at 20.70 billion in financial year 20. The Union Cabinet has given its note for the amendment of existing foreign direct investment policy in the pharmaceutical sector in order to allow FDI up to 100% under the automatic route. So India plans to set up a nearly, you can say, how to improve this particular sector. Even in Union Budget 2021, 65,000 crores have been allocated to the Ministry of Health and Family Welfare. Government has allotted 34,115 crores towards the National Health Mission under the rural and urban peoples are getting the benefit under this National Health Mission, NHM. So these are the plans are coming. As per the economic survey, 2019-20, government expenditure as a percentage of GDP increased to 1.6% in financial year 20 from 1.2% in financial year 2015. So over this 5 year, almost you can say 0.4% is the increment in the government expenditure, which is not a matter of joke. Manufacturing volume after declining up to, you can say, as we all know, that the March, April, once when the lockdown has been declared, even the manufacturing in pharmaceutical sector reduced to 50 to 60%. But again, in 2 months later, July, August, we observe that it moves up and 60 to 80% original capacities they are operating. And near future, they are going to even supersede the 100% capacity of their capacity. Now, banking sector. So financial and economic condition in our country are far superior to any other country in the world. There is no denial. I have already mentioned in the year of 2007 and 8, when we were facing the great global depression, economic crisis, then it was only the good banking prudential norm which could save our economy. So public sector banks assets presently stood at about 73 lakh crore. And during 16 to 2020, credit offtake grew at a compounded annual growth rate of 13.93%, almost 14% as of financial year 20. So total credit extended. But as I have mentioned earlier, that the RBI already shown in its financial stability report that NPA is going to improve. In 19 financial year, we have observed that the banking and financial services witnessed more than 32 merger and acquisition activities. Now, in March 2020, SBI, India's largest lender, we all know, raised $100 million in green bonds through the private placement. So deposit under the Pradhan Mantri Jan Dhan Yojana have also improved a bit. But what we are observing, in the name of the Sangam and Indradhanus, which schemes are going to be launched by the central government, union government for the reform measure in banking sector, that many banks are going to be merged. Only finger count 4 or 5 public sector bank would be operating in our economy. Allahabad Bank boards approved already the merger with the Indian Bank for consolidation of the 10 state-run bank into the large-scale lender. So under the budget also in 1920, government proposed 70,000 crores to the public sector banks. So in one hand, the union government is trying to revive this sector, but on the other side, we are also lapsing on some prudential norms. And that is why the MPA is being improved year by year. According to RBI, India's foreign exchange reserve stood at approximately 414.14 billion as of April 19, 2020. So unified payment system and other technological based or internet based payment mechanism have been improved. Now, my dear friend, if we will very quickly give a look upon the MSME sector, then we observe that it is contributing 30% of our GDP and contributing 45% of the total our national export. 12 crore employments are being offered from this sector, and 71% of the business were not able to pay their salary in the month of March, when suddenly this lockdown has been declared. Although union government has announced 3 lakh crore package, and among them already 1.7 lakh crores have been disbursed, and the residual amount is yet to be disbursed. But still, I am telling you, the sectors like online gaming, telecommunication, and e-education operating in the digital space are witnessing a positive impact on these, because they are leveraging opportunity during this pandemic. It will take minimum 7 to 8 months for an average MSME to recover. If you will look on the travel and hospitality sector, then India was globally the 3rd largest in terms of the investment in travel and tourism, with an inflow of $45.7 billion in 2018 and accounting for almost 6% of the total investment in the country. Can you imagine? So 6% of the total investment, almost, it is absolute figure 5.9 point something percent, 5.9%, right? So hotel and tourism sector received cumulative FDI inflow between April 2000 and March 2020 is about 15.28 billion US dollar. So during 2019, foreign tourist arrival FTA in India stood at 10.89 millions, right? So achieving a growth of 3.20%. According to World Travel and Tourism Council, WTTC, India ranked third among 185 countries in terms of travel and tourism total contribution to the GDP in 2018. So India is the very, very potential in this particular sector, and government is also trying to survive or give some support to this sector. Under the budget, Union Budget 2021, Government of India has allotted almost 1,200 crore for the development of the tourist circuit under the Swadesh Darshan of 8 Northeast states. Government of India has allotted 207.55 crores of US dollar for development of the tourist circuit under the Prashad scheme. So these schemes are coming, but what we are observing that the real growth, real execution of these plan and schemes are far away than their announcement. Ministry of Tourism sanctioned 18 projects covering the northeastern states, and it was more than amounting, you can say, 1,500 crores of rupees to develop and promote the tourism in this particular region. But if we will precisely look upon the RBI survey report, then we observe that as per this FSR, that is the Financial Stability Report, it will take at least 3 to 5 years to get the recovery. The percentage of response that thinks chances of recovery in 6 months are very, very minimum. The majority of the people are thinking that it will take huge period to recover. Now, construction and real estate was doing badly even before the lockdown period. Now, business in 21st century, as I was talking about, must have to transform, because the pattern of doing the business must be changed. Otherwise, we will not be in a position to survive in the changed business environment. Now, here the challenge is lying with us to transform the business risk into the business opportunities. Huge revenue growth would be there if Indian IT sector grows artificial intelligence, robotics, or automation, etc., as I have talking about. So business continuity plan is the responsibility for every employee. Risk management and business continuity plan have become the critical issue for any organization to get the business resilience. But one issue lastly I wish to touch upon, that is the role of charismatic leadership. Now, failure of the leadership has a cost to the entities. Why only entities? Rather the organization, to the nation, community, society. Because we are observing there is a loss of life, loss of job, loss of business opportunities for the business sectors, loss of normalcy for the common citizen of the country. And there is a loss of certainty. We are uncertain about the future. But earlier, these were not the situation. Now, privatization is going on. I was listening yesterday in this seminar only, vocal for local. But you see, you cannot suddenly transform your economy. Since last 30 years, you were advocating for the globalization, etc. And suddenly, one fine morning, you can say, vocal for the local. It is not possible. Now, building public distribution system more stronger and allowing the equal opportunity for all the population, that should be the main target and that should be the main issue before the policymaker. investing in public infrastructure like, say, for example, health, education, public transportation. All these should be the priority for the policymaker. Creation of employment opportunity is the very, very important issue. So with few these words, I wish to convey my sincere thanks to the organizer who have given me this opportunity to share some of my sentiment with all of you. So I again extend my thank to you all. Thank you, sir. Now hand it over to the chairman.
Thank you, Professor Ram.
Thank you, sir. Thank you. Pranam.
You have really given a thought-provoking speech covering all aspects of the economy, pharmaceutical, the travel, tourism, manufacturing sector, service sector. This is the job of a true academician, which you have certainly fulfilled. In first part of your lecture, you have given the negative, means the pessimistic scenario of the Indian economy. But at the end, you have given some optimistic. Professor Ram is a true academician. So whatever he has studied, he have elaborated and discussed with the panel members. I think nowadays, this is a short period pandemic scenario of this economy, particularly in organized sector. I think I assume the things will recover very fast as well as the pandemic scenario or corona, this crisis will get over here. Just in 30 seconds, I'll discuss whatever we have observed here in the market of Jodhpur. We have conducted a survey through our students here, and we come to know, like, whenever the lockdown get over, the sale of particular sectors get double. Means whatever they have sold in the previous year, 2019, in the same month, the sale was just double here. Means as soon as the things will recover and it will be normal, I think the economy, the speed of economic development will be little faster here. But if we see the data, whatever Professor Ram presented, it's really that is the true picture. How the scenario is adverse, everyone agree. But I feel the things will recover, and there are many sectors which have opened up for Indian economy. Like Professor Ram has mentioned travel and tourism, medical tourism, physical tourism, pharmaceutical sector, education sector. There are many sectors which will open up for Indian economy to work better. And declining of China's economy has opened up another opportunity for Indian economy to take up or to take over here. I was listening in this technical session. I was listening to the keynote speaker from Canada. She mentioned that here in the market there are two segments, local segment and foreign, means the Chinese or others here. So people are diverting and moving towards the domestic demand and domestic. If this will increase, I hope the scenario will of Indian economy will be brighter, better than ever. And there are many areas, particularly in technology, as Professor Ram has also mentioned, IoT, this artificial intelligence, technology everywhere, fintech, edutech, insurance tech, everywhere the Indian economy is growing and adopting the technology, and this technology will lead in global market here. Thank you, Professor Ram, for elaborating the scenario of manufacturing sector in Now I hand over this further proceedings to Professor Arindam Das to call.
Sir,
Okay,
may
sir,
I
there is one question. Sir, with the permission of the chair, there is one question from
Yes,
Professor Arindam Gupta. He has written the question in the chat box. So,
Yes, keynote speaker is there. We can, I think, ask to keynote.
So, Professor,
Yeah,
please say in
I
few
was-
words in the present state government policy in the West Bengal of not joining the central scheme, and it's taking away from the just causing further distress for the people of the state. I seek your opinion. How do you perceive this curious situation?
Yeah,
So it's the
Arindam,
question
thank
that
you.
is given.
Yes.
Has been put forward by
Am I
Professor
audible?
Gupta. Yes,
Yeah,
yes.
May I
Yes, yes.
respond to the query? Yeah. Sir, actually, I was also trying to interrupt you as soon as I see the question in chat box. You see, the reason behind not joining the central government scheme, that may be their political or other reason. I'm not going to highlight on this issue. But what the Arindamda has tried to raise by saying this question or by commenting like this is that, you see, my personal view in this regard is this: may it be the central government or a state government, we, as per the Constitution of India, even the fundamental state services should be sponsored by the government of India to the common people. And there is a provision in our different article of our Constitution itself. So what happened in both the level, at union government level as well as the state government level, the government are coming up with the more plans, programs and schemes of different types. You cannot deny this, that you see, presently we are having the National Health Mission, but prior to that also we were having so many health schemes. So right now we are talking about the Ayushman Bharat, but prior to that we have so many health schemes. Now in 2004 and 2009's union governments, UPA government, you will look upon their working, then they were having the tremendous achievement, not only on the health frontier, but on so many other frontier also. And state government also, in not only in West Bengal, rather in any province, may it be the Karnataka, Tamil Nadu, Bihar, Uttar Pradesh, whatever it may be, when there is a change, political changes in the government, then we observe that they are simply nurturing up to 5 to 10%, not more than that, I personally believe. And they are coming with one or two major plan and programs. But in majority of the cases, they are going to adopt the simply make the changes in the name of the plan and programs or schemes. One program was there, but only they are going to make the change the name, and you will never find that they have introduced the new project, and even they are introducing. So the reason behind not coming into the Ayushman Bharat project or like that, maybe the some political, because they know that once the people start getting the service under one scheme, then what I am offering to the population at large, they might be misleaded. And you see, there is the conflict, their political, you can say the inter-conflict between these two, state versus union. But ultimately, the fact, what I was trying to present in my presentation, that the PDS or the public spending in the health, education and the transportation sector should improve. Otherwise, this issue is never going to be resolved. Thank you.
So there is another question. Should we take the question, Chairman sir? Another question
Yes,
that was
one more
raised
can
by,
be taken from keynote.
okay, so that question was raised by Dr. Sharnabha Das to Professor Chaudhary. Do you think that the cash benefit to people can be a measure to overcome the present situation?
You see, if you will look upon the work done by the Abhijit Binayak Bhattacharya, and prior to him, even the Amartya Sen, both of these Nobel laureate, and even Professor Khan of Bangladesh, all of them have focused or emphasized on releasing some purchasing power in the hands of the common people. There is no denial in this. But what we are observing, this direct benefit is being transferred, but the benefit is not being extended. What happened? I have forgot to mention during my deliberation, we are observing that the economy is contracting, but the inflation is not coming down. What is the reason behind it? So under such a scenario, even if you are going to give some cash benefit, direct benefit to the, of course, you can say that one part can be taken care, that may be the corruption or cut money sharing within the amount of scholarship or some other things, what our benefit is being transferred to the incumbent. That issue can be taken care. But so far as concerned about releasing the purchasing power in the hands of the common people of the country, that can only be made viable if the real amount will be given to the common people, which is not being given. Very few amount is being given either in the Jan-Dhan accounts or with some Kishan credit card or like that. And what happened? In case of the Kishan credit card, they are also trying to recover the money. So under the circumstances, what happened? Arindam Da is asking Professor Ram just, okay, one minute.
Professor Ram, be brief. You are full
Yes,
of
yes,
energy today.
one more, yes, sir.
We can open up the session at the end, Professor Arindam Das.
Yes, sir. I'm completely in agreement with Professor Arindam Gupta, sir, because as I have told you, so what happened, direct benefit should be given, but the amount what should be given by the government to make these people self-reliant is not being given. That is my humble submission. So what happened, the spending on the part of the union government as well as the state and local government should be increased. Then only these issues can be taken care. So with this, thank you, sir.
So thank you, Professor Chaudhary, for enlightening us with your thoughts, and we are really mesmerized by your speech. So at the end, if we get time, we'll get back to you. So since we are running out of time, so with the permission of the chair, now let us move to the paper presentation part. So first, I would like to call upon Dr. Abhijit Sikdar for your deliberation. So Dr. Sikdar, would you please start your presentation? Dr. Sikdar? Can you hear us, Dr. Sikdar?
You can call sir second one.
Okay.
Yes, okay, sir. Hello?
Hello. Yeah, you are audible.
Yes, sir. Now, sir, can I present?
Yeah, of course.
Yes, sir, please.
Presentation, sharing the screen. Screen presentation. Okay. So is it visible?
Yeah, it's coming. Okay, it's visible. Okay, please start.
Okay, sir.
So you get 7 to 8, maximum 7 to 8
Okay,
minutes.
sir.
time.
Okay, I will complete.
Okay.
So, thank you, sir. Good afternoon to everyone, chairperson and all dignitaries, especially the organizing team for giving me the such opportunity in this wonderful platform. Thank you, sir. And the background of my study is under the present scenario of pandemic of COVID-19, what is the impact of COVID-19 in the stock market volatility during this pandemic period. I have bifurcated my study period into the two part. Sorry, I have not mentioned, okay. I have bifurcated my study period into two part, pre-COVID-19 and post-COVID-19. The title of my paper is Study of Volatility during a pre and post COVID-19 pandemic, a case study with reference to Nifty. Myself, Abhijit Sikdar, Assistant Professor, Khidirpur College. The objective of my study is to identify the nature of the distribution, whether it's normal or lipocartic, to study the existence of the unit root, that is stationarity, or the return series, to compare the persistent and clustering of the volatility of the Nifty return of the two frame, to capture the leverage effect of volatility of Nifty return of two subperiod now, and to study the risk return relationship of Nifty return of the two time frame. My research methodology, as I've already told that, I am just want to study the nature of volatility pattern, that a fluctuation around its mean, around the expected return, the dynamic fluctuation nature of the stock market. We have studied the entire paper based on the two time period. One is pre-COVID era and one other is post-COVID era. My first sub-period is September 2019 to 2020, and second period is March 2020 to August 2020 for the effect in the stock market. For the stock market, we have considered the Nifty, one of the most acceptable index in India, since it is reflecting more or less the entire economy, financial, non-financial, manufacturing, technological, pharmaceutical. So I have considered that index for my study purpose. I have used the EViews for that purpose. Research tools for each and every objective I have defined. I have used certain research statistical tools. First of all, I have used the Jarkabera statistics to identify the nature of distribution. Then I used the augmented DT-Fuller test as well as Philip-Potran test to study the stationarity of the return series. Before starting that, I have studied the Arch-LM test to study whether there is an arch effect exists in the mean return. Then I have used Garch model to study the persistence and clustering of the volatility between two periods. Next, I have used the E-Garch model to identify the asymmetric of information, that is volatility leverage effect. And last of all, I have studied Garch M model to capture the risk-return relationship between the two models, between the two periods. The descriptive studies is in front of you. I have just mentioned that Jarkabera statistics indicates that there is not a normal distribution. Not even that. If you look at the kurtosis, it is more than 3. In the both period, it is more than 3. So in that sense, we can say that it is not normal, it is rather lipocardic, and that has been further confirmed by Jarkabera statistics, and its probability is significant. So we can say that we can reject the null hypothesis that the return series are normally distributed and accept that return series are not normally distributed. One thing I have to mention that I have converted the daily return into annualized return, and we can look at the return of the pre-era, that is 17.7%, and whereas post-era, there is some printing mistake, it is near about 13.52%. And annual volatility is much more in the pre-part than post-part. Now, I have studied so first of all, I have confirmed that it is not a normal distribution, the return series, and it is a lipocardic. And then I move to the checking of the stationarity using the augmenting DK-Fuller test and Philip-Potran test statistics. That statistics indicate that, yes, there is the existence of unit root because both state has statistically significant. And so we can say that the both state, whether it we test with trend or without trend, I have not mentioned here, in my paper I have mentioned with trend or without trend, it is statistically significant that there is a return series is not, it indicates a stationarity. Now we have moved to the Arch-LM effect in the residual of mean, because before implementing or before using the Garch model or general autoregressive regression model, I have to think I have to pass the two part. First, it should be a stationary series, which have been confirmed on ADF and PP test. Next, what I have to do, I have to check whether the arch effect exists in the mean return or not. So I have confirmed, I have set a 2 mean return, pre and post. And that is a mean return. I have to take a auto-regressive mean return, that is current year return also reflected by past year return. And it indicates in a pre-situation and post-COVID situation, I am giving here only the pre-COVID situation, that the return is, there is a heteroscedasticity, that is Arch-LM effect exists in the mean equation, which has been confirmed by Arch-LM test. Same thing I have been conducted for the post-COVID-19 era. The result is same. Now I am moved to since both condition has been satisfied, now I am moving to my next part, that is the Arch Garch model for the estimation of the nature of the volatility. So I have estimated that I have presented the pre-COVID era and the both arch effect and Garch effect. Arch effect means that is a large changes tend to be followed by the large change of either sign, and small changes tend to be followed by the small changes. So clustering effect and effect is estimated by alpha, that is residual square, and which is statistically significant in the pre-era, and Garch effect is statistically significant at 0.05. I have to mention at that point that arch effect basically indicates the shock of the previous day's return in the current day, and the Garch effect indicates the volatility of previous period in the current period. We can see that in a pre-period, the current period return shock, the Garch, has been significantly affected by pre-period return shock. But while I am giving to my focus on the post-COVID-19 era, exactly same, both are significant, but that is they are significant, but one is important. Interesting effect is that the Garch effect volatility, that is previous period of volatility, has a significant impact on the current date volatility, and past date return has a significant impact in the current date. Past date shock has a significant impact in the current date volatility, but that the influence is even significant, but the influence of arch effect is less than Garch effect. One of the reason, in my opinion, is that because the economic activity during the post-COVID scenario, during that lockdown and economical shutdown, we can say that there is no economic activity is going on. Certainly, though no significant shocks are coming. So even if there is a
Dr.
Garch effect,
Avjit,
yes, sir.
please conclude.
Okay.
You have 1 minute time, please.
Okay, sir. Thank you. Now I move to our next e-Garch model, where we have studied only the leverage effect, which is statistically significant, and we indicate it is a negative. That means positive shock have a more impact in volatility. Sorry, negative shocks have a more impact in the volatility than positive shocks. Effect, same thing we have observed in the post, but the sign is different. Now we are moving the Garch LM test only for the CAPM application is applicable or not. We have seen that both period there is a significant impact of the risk return, but they are not statistically significant. Even though they are not statistically significant, but the sign of Garch with the return is indicates a positive. Both period we are giving the same indication. Conclusion is that post-return 19 era, post-COVID-19 era, return is higher than return of the pre-COVID era. Nature of persistence is slightly higher during the pre-COVID-19 situation. Impact of negative shock on the volatility is more in the post-COVID-19 situation than pre. And the coefficient of risk return premium is higher during the pre-COVID-19 sub-period. So that is my humble submission. Limitation is that, sir, we have taken a very short period, only 6 months. We have not taken the external shock, only we have considered the internal shock for that my study period. And we are not considered intraday volatility. We have taken only the intraday volatility. So thank you, sir. I am indebted for you the patience hearing. Thank you, sir.
Thank you. So over to Chairman, sir. Do you have any observation? Or should we move to the next?
I think I have observation and noted I think we can I can make observations at the end.
Okay, okay, sir. Okay,
we can call everyone, and even answer also we can open up the session for 5 or 10 minutes or at the end. And I request to whom anyone have question, please mention the name to whom you want to ask question. Okay, so your question will be in the chat box, and at the end we can open up for 10 minutes or 15 minutes as per the requirement for question answer, and then I can make observations. I think better Professor Arindam Das is.
Okay, sir. Okay, sir. So let us move to the second presentation.
Yes.
First, Dr. Anupam Karmakar to start your presentation.
Okay.
So what to Dr. Karmakar?
Is it visible?
Yeah, absolutely visible.
Okay, respected chairperson, sir, my paper is entitled A Study of the Impact of COVID-19 on Indian Manufacturing Sector and Policy Recommendations. The introduction part, we know that manufacturing is one of the highest growth sectors of India. And to uplift India as a manufacturing hub in the world map, Prime Minister announced Make in India program in the year 2014. The manufacturing sector contributes 20% of India's GDP. And one of the sector of manufacturing is automobile, which contributes 7.1% of Indian GDP. And the interesting thing to note is that in automobile sector, 100% foreign direct investment is allowed. Coming to the review of literature, according to the Ministry of Commerce and Industry and Ministry of MSME, demand for cars is likely to be deferred or dropped given low consumer confidence, subdued economic activity, lower disposable income, and higher prices. The main objectives of my paper are to highlight the manufacturing scenario and to examine the challenges faced by the manufacturing sector of India during COVID-19 and to identify the reasons for slowdown in the manufacturing sector during lockdown and unlock period, and to suggest some policy measures to review the manufacturing industry of India during the unlock period. The research methodology, I have consulted some reports of PwC, CRISIL, FICCI, and I've also consulted Center for Monitoring Indian Economy and the Society of Indian Automobile Manufacturers report. Now, this is the table which shows the index of industrial production, which shows the growth of sectors like manufacturing, mining, and electricity. It is a short-term measure compiled by the CSO, which shows that during the lockdown period of April, May, and March, it is negative. And if you consider this figure, you can see that the IIP of 2019, which is indicated by the blue dot lines, and the highest negative figure of IIP occurs in the month of April, minus 57.6. After that, it has recovered towards a positive figure. Because of the measures taken by the government for production activities, relief measures adopted by the RBI for reducing interest rates, and relief packages adopted for MSME sector by the government. Now, next is the Purchase Manager Index. Reading over 50 indicates growth in the manufacturing sector as compared to the previous month, while reading under 50 suggests contraction. So you can see after the declaration of lockdown for the month of April to July, that means there is a contraction in the manufacturing because the PMI reading is below 50. Now, I've considered some sectors in the manufacturing like automobile, cement, steel. You can see the production of cars is zero in the month of April. And if you look at the figures of 2019 June and June 2020, as well as July 20 and July 2019, you can see that the production was negative compared to June 2019, minus 49.6. And in case of July, it has reduced to minus 3.85. In case of passenger, similarly, there is a decrease in the production rate from 38.6. That means it has reduced. That means that demand is increasing for the two-wheelers, passenger vehicles, and three-wheelers, because the public transportation system is now not preferred by the people. They want their own transportation. That is why the production in the sector is increasing. Though from January to June, the NSE Auto Index has given a return of minus 20.39. Now, coming to the impact on cement industry, the demand in the cement industry declined 45 to 50% year on year in first quarter of the financial year 2021. And in case of steel production, the gross manufacturing of finished steel declined 27.4% year to year, the worst ever decline since 1995. Now you can see this is the balance of trade position, which indicates that in the month of March, April, and May, the balance of trade is in the negative, and it has registered a positive in the month of June, and again it has registered a negative. And the unemployment is maximum during this lockdown period of April and May, though in the month of June and July it has declined to some extent. I have given some reasons, identified some reasons for this manufacturing slowdown. That is supply chain distributions, lower imports from China, lack of availability of workers, lower profitability, difficulties in managing debt obligations, and cash flow liquidity challenges. Some policy prescriptions, as Nobel laureate Abhijit Vinayat Bandyopadhyay has rightly said, that we have to increase the demand, and for that purpose, we need to distribute money in the hands of people so that their demand can increase, that is the purchasing capacity. Now the Indian manufacturing sector need to take the manufacturing opportunity of India, like lower operating costs, strategic location, cheap labor, highly skilled workforce, world-class infrastructure, manufacturing competitiveness. Only then the manufacturing industry can revive. Now the digital transformation, the production was more or less stopped during the lockdown period. But if they took the help of this adopt dark factory, that means industrialization 4, that is running a fully automated factory, then the problem could have been solved. We need more FDI into manufacture, in the manufacturing sector to boost up the manufacturing sector. Now coming to the conclusion part, the government in our country is primarily focuses on encouraging the manufacturing sector through Make in India and Atmanirbhar Bharat Abhiyan. But these two programs are going to badly affect the FDI inflows in the country in the coming years and in the post-COVID-19 period. Another thing I think is that import restrictions from China and other countries of the world is going to affect the manufacturing sector badly. It is difficult to assess the real impact of coronavirus on manufacturing sector, but one thing is clear, that the impact will be substantial and pervasive. India's manufacturing sector is now at crossroads due to this global pandemic. The Make in India of 2014 has given a projection of 25% share of manufacturing sector in the GDP and 100 million jobs in the sector by 2022, which has come to a grinding halt due to spread of COVID-19. Finally, we all understand the value of manufacturing sector in reviewing the fortunes of Indian economy, but India needs to devise strong strategies to fight with aftermath of this global pandemic. Thank you.
So thank you, Dr. Kormukar. So let us not take any questions. So straight, let us go to our third presentation, move to our third presentation. It's a joint paper. The writers of this is Jayashree Das and Srijita Datto, and Srijita is going to give the presentation. So over to Srijita.
Thank you. Thank you, sir. Sir, am I audible?
Yeah, absolutely audible. Please start your presentation.
Okay. Our paper title is Impact of Lockdown and COVID-19 on Indian Pharmaceutical Companies and Empirical Study. As we are allotted 5 minutes time, so I will directly focus on the objectives, methodology, findings and conclusion of this study. The objectives of the study are to study the impact of lockdown and COVID-19 on Indian pharmaceutical industry with special reference to 9 pharma companies under Nifty 50. And another objective is to study stress and anxiety level of medical representatives of pharma companies belonging to the age group of 27 to 55 years. Our study is conducted between the period of April 2020 to June 2020. Our methodology is the approach adopted in the study is survey approach. The research instrument used in this study is questionnaire, specifically BAI and PSS questionnaire booklet and
So
over the telephone.
sir, Srijita, are you presenting anything? It's not visible.
No, sir. No, sir. Shall I present?
Yeah. If you have the PPT, you straight go to the share screen.
I already sent the PPT through mail.
It's okay, you can continue.
Okay.
If you are
Okay, sir.
PPT,
Okay,
you can continue.
Okay.
Okay, sir. The sample size is limited to 100 medical representatives of Sun Pharmaceutical Industry Limited, Cipla Limited, Mark Pharma Limited, Lupin Limited, etc. Convenient sampling method has been used. Time period of study is 1st April 2020 to 1st June 2020. The test was conducted twice, first on 1st April 2020, that is the beginning of the lockdown phase, and on 1st June 2020, that is in the end of the lockdown phase. We have
You are not audible. Can't hear you.
Arindam sir, I think she has some technical glitch.
Technical difficulty.
positive impact is observed due to pandemic prevailing more cautious about their medicines to institute. Hello?
You are audible. Please
Hello?
complete your presentation. Please.
Sir, it is a protocol, Professor Arindam Das, that
Okay, sir.
it's present.
Due to this, the net profit of
video
these
on.
pharma companies are increasing.
Even you can open up your video, is not visible.
It's a standard protocol for online
Yes.
presentation.
Srijita, can you open your video?
Yes, sir.
Okay, so please open your video.
You yourself is not visible.
Okay, sir. Sir, I think there is some settings needed. It's not allowing my camera.
She may be continuing.
Okay, Srijita, if time permit, we can take you at the end. Okay, you wind up conclusion.
So shall I continue now?
Yeah, Srijita, come to conclusion here. I can understand you have some technical problems, and if it is so loud, we can give you some time at the end.
Okay, sir.
Okay, try to be visible at the end. We'll take
Sure.
you at the time of question answer.
Okay.
Continue, please, and finish.
Okay, sir. I'm continuing. Many pharma companies show low debt increasing profit, which indicates strong cash generating ability, which helps in cash from options. Many of promoter pledge, many of them shows return on capital employed is impact the pandemic and lockdown phase on the representatives of these pharma companies. Stress and anxiety levels are very high in the medical representatives. Their BAI and PSS score indicates persistent level of both stress and anxiety. The two main causes of this stress was the medical representatives did not receive the incentives in the recent time, and even they were cut down on their incentives of the previous years. Another vital reason for their stress level elevation was as they were looking on the fields but were not supplied with enough protection from their company. That is, the PPE kits were not supplied to them for their safety from this coronavirus. For now, I'm concluding. Few of these small companies may find themselves under anxiety and could become origin of the additional volume that the larger players with deeper pockets are looking at. Some companies that are seeing for their portfolio have also started incentivizing employees, especially in the production field, who are supporting plant operations during this COVID period. India's active pharmaceutical ingredients prognosticate to attain the revenue of 6 billion by the end of 2020. Indian manufacturers relied heavily on APIs from China for the manufacture of their medicine formulations, obtaining around 70% from China, the top global producer and exporter of APIs by volume. The Indian government should take important steps to remove the technical and financial barriers that will stimulate the pharmaceutical industry to accumulate API production, reducing the reliance of the pharmaceutical industry as a whole on the heavily affected Chinese market. Companies' revival strategies should be capital expenditure, looking at renegotiating rentals, looking for new sources of incomes from owned assets and as digital mechanisms for meetings and conducting since telemedicine, video consultations, health-related videos and apps are gaining popularity. Digital health is the penultimate. Investments in online portals that will help doctor-patient interaction to expand. With this, I'm concluding. Thank you.
Sure. Thank you, Srijita Datto. So the next
Thank you,
presenters
sir.
are Mr. Shondeep Bashak and Shayani Shikdar. So I request Mr. Bashak to please start your presentation. Mr. Bashak, can you hear us? Mr. Bashak, can you hear us? Or should... So let us move to the next paper presenter. Mr. Bashak, can you hear us?
Probably he is not.
Okay.
Not visible on the platform. Can call next.
Sir, am I audible?
Sir,
Sir, am I audible?
Yeah, audible. You are audible.
Okay, sir, I can share the PPT right now.
Yes.
Maybe there are some technical glitch. Okay.
Should we share screen?
Huh. Am I visible right now?
Yeah, visible.
Okay, okay. Thank you, sir. Good afternoon, respected my professors presented over here, and chairperson and my dear participants. Our joint paper, and the name of the paper is Analysis of Financial Stability of Banking Industry in India During New Normal Stage, an empirical study. Here is the introduction. Actually, our paper or our study attempts to measure the relative performance of some private and public Indian banks, taking into consideration profitability analysis with respect to several significant variables that indeed affects profitability to a large extent, and how government tries to encounter the unprecedented threat coming from the pandemic towards this industry. Now, for the shortage of time, I am skipping all these, and right now I am coming into the objectives of our study. This study simply aims to analyze the financial health of Indian banking industry, taking into account the effect of the pandemic on the basis of a sample of 10 private and 10 public banks over a period of 5 years, ranging from 2015-16 to 2019-20. Data and methodology, actually here the sample selection, only 10 private and 10 public banks. Period of study I have already mentioned, from 2015-16 to 2019-20. Key variables, there are 5 key variables. Net profit is taken as dependent variable, and independent variables are 5, that is net interest margin ratio, DTLR, that is the deposit to total liabilities ratio, return on asset ratio, credit to deposit ratio, and capital adequacy ratio. Statistical tool, the linear regression model has been used, where net profit equals to beta 1 plus beta 2 NIMR plus beta 3 DTLR plus beta 4 ROAR plus beta 5 CTDR plus beta 6 CR and plus standard error, where beta 1 is the constant term, beta 2 simply change in the firm's profitability with respect to change in the NIMR, beta 3 is the change of the firm's profitability with respect to change in the DTLR, before changing the firm's profitability with respect to changing the ROAR, beta 5 changing the firm's profitability with respect to changing the CDR, and beta 6 changing the firm's profitability with respect to changing the capital adequacy ratio or CAR. Data analysis and findings. First of all, we have done correlation test among the variables. Since the thumb rule of p-value less than 0.05, naturally it is not satisfied in case of 2 variables, and therefore we have dropped those 2 variables, that is deposit to total liabilities and credit to deposit ratio, and then regression analysis has been done. Model summary shows that the selected variables can explain 61% of the total variance, which is in a satisfactory level to some extent. ANOVA result goes with the thumb rule, that is p-value is lesser than 0.05. And VIF, on the other hand, collinear statistics as a result of Darwin-Watson test show the VIF factor in case of NIMR and ROAR exceeds the thumb rule, that is 2. Since the VIF value is higher in case of NIMR, therefore another correlation and regression tests are done after dropping the variable. Correlation test reflects that both the independent variables satisfied the correlation test as p-value is lesser than 0.05, and correlation between dependent and independent variables are all not at a satisfactory level, and our result does not hold good as p-value is greater than 0.05. VIF factor in case of all the independent variables are good as lying below 2. Thumb rule of Darwin-Watson value, but R squared dropped to a large extent, which reflects the researchers' predictions are absolutely wrong. So the accepted linear regression model is net profit equals to minus 342.201 plus 2967.395 ROAR plus 17.39 CAR. Actually, net profit here, it means that for 1% change in ROAR, net profit will be changed by 2967%, while for 1% change in the CAR, net profit is bound to be changed by 17.39%. So between two variables, ROAR is more effective than CAR as far as net profit is concerned. There are some measures that have already been taken by the union government, like the targeted long-term repos operations announcement from RBI aimed at injecting around rupees 50,000 crore of additional liquidity into the banking system. Justifying the risk appetite of banks, special liquidity scheme of rupees 30,000 crore for NBFCs and mutual fund institutions, along with rupees 45,000 crore liquidity infusion through a partial credit guarantee scheme 2.0 for NBFC has been launched by the finance minister as a part of first tranche of the rupees 20 lakhs. Conclusion. This study, through a regression model, rightly points out the variables in the banking industry that has a strong association with the net profit earnings. High performance banks and banks dedicated to improving their performance care about profitability oriented performance measurement and management. Profitability oriented performance measure management is necessary both to know what a bank can do, affect profits, and to benchmark the effect of such moves. Further, the profit-oriented measurements translate organization strategy into functional level goals that are mentioned at the right levels and frequency to deliver predictable improvement in several other metrics and also their valuation. There are few recommendations. Actually, some performance measurement frame has been given below that can supposedly help banks in overcoming typical challenges in performance measurement and financial stability. Those are establish consistent responsibility structure, balance long-term and short-term focus, make value-based strategies operational, embrace information transparency and accuracy, focus on what is truly important. Next one, enforce performance-driven behavior, balance integration with simplification. That's it. Thank you, sir.
Thank you, Mr. Basha. So next, let us move to the fifth presentation by Shatabdi Dey. So Shatabdi, please start your presentation.
Yes, sir. A very good afternoon. The title of my paper is Insolvency and Bankruptcy Ordinance 2020, an overview regarding benefaction and inconsiderateness. First of all, Insolvency and Bankruptcy Code 2020, Insolvency and Bankruptcy Code 2060 is the bankruptcy law of India that seeks to consolidate the existing framework by creating a single law for insolvency. Now, Insolvency and Bankruptcy Ordinance 2020 is the latest amendment announced by the President of India on 5th June 2020. The ordinance, the recent modification in insolvency regulation is a part of the Atmanirbhar Bharat Abhiyan to provide some relief to the distressed companies, and the IBC ordinance has suspended few sections like section 7, section 9 and section 10, and it has inserted section 10A and 663 for as no application can be filed by financial creditor as well as operational creditor, and 66.3 stating that the resolution professional can also never file any complaint, can also never proceed for application for insolvency. not only in India, a large number of countries like Germany, France, Spain, they have already implemented a temporary change in insolvency framework. Like Germany, Spain, they have suspended the insolvency from 30th September and 31st December respectively. Then France as well as Poland, they have also suspended the law for from March 2020. And so many countries are there, those who have implemented a temporary change in the insolvency framework. Some of the literatures have been summarized here. Now, the objective of my study is to understand the role of Insolvency and Bankruptcy Ordinance 2020 in light of COVID-19 crisis. And second one is to evaluate the challenges and threats of the creditors, both the financial creditor and operational creditor under the current regulation. So why the IBC Ordinance 2020 is important? The Act, that is IBC 2020, provides perpetual protection to the corporates that are suffering from losses and not in a position to meet its obligation, and therefore this is basically the law protecting the corporate debtors or the corporates from to maintain their going concern concept, and it is also maintaining the stability of the for the corporates in the organized sector, as well as the unemployment can be reduced or can be reduced by maintaining the stability in this particular sector, and automatically the corporate debtor will get enough time within the next 6 months, and if situation arises, then at least 1 year for restructuring the company's capital, as well as they will get enough time to rejuvenate their confidence. Now, at the same time, there is some crisis that is being faced by the creditors, both the operational creditors as well as financial creditors. Most of the cases, the financial creditors, the banks and financial institutions, they will suffer from lack of liquidity. Non-performing assets of the companies would get increased, and if the situation continues, that the bank, as it is said in the ordinance, that 6 months can be extended up to 1 year. So there is no chances that banks or banks and any other financial institution will get any priority over the other creditors at the time of any driver situation. So they will be in great trouble. Alternatively, the operational creditors, they also suffer from lack of fund for the smooth operation, as most of the cases the operational creditors are the micro, small and medium enterprises. The threshold limit has already been raised from 1 lakh to 1 crore in the previous amendment of 2019. So this could be a challenge for the operational and financial creditor both. At the same time, it is very beneficial to the corporate debtor as they are getting enough time to restructure for restructuring, as well as if the 6 month time limit is extended from 6 months to 1 year, so corporate debtors could take shelter for perpetual protection for a longer period of time. Now, moreover, overall, the Insolvency and Bankruptcy Ordinance is a special amendment due to the pandemic situation, and it basically helps corporate debtors for their survival and as well as maintaining the stability of the economy. But there are, as we have said, that there are few challenges that is being faced by the operational creditors and financial creditors. Still, there is some solutions for them. First of all, financial creditors, the risk that is being faced by the financial creditors, for them, the potential losses can be adjusted through different financial reforms in banking sector and different adjustment in quantitative and qualitative measures. Moreover, there is some recovery processes there under Section 19 of recovery of debt dues to banks and financial institutions. So these are the solutions that can be stabilizer for the financial creditors, as well as like the financial creditors, operational creditors. For the operational creditors, there are some solutions like commercial court for recovery is one of the solutions for the operational creditors. Small SMEs can proceed under Samadhan scheme for debt recovery. If some corporate debtors are assuming that they can take shelter for perpetual protection under the said act, but it is not true, because corporate debtor owing repayment, including interest to MSMEs, will not be able to exempt itself from the ordinance. MSME has defined, the government has redefined the definition of MSME under the new amendment. So more sectors are under the concept of MSME, as well as Government of India has made an approval of equity infusion of rupees 50,000 crore of fund-to-fund basis, as well as collateral-free loan has been allowed for the MSME sector. So moreover, it can be said that it is going to be a survival for the coming days also. Both the corporate debtors as well as the operational creators would get a good solution under the scheme. Thank you.
Sir Das.
Saha, Mr. Saha, please start your presentation.
Am I audible, sir?
Yeah, absolutely audible.
Good afternoon, Chairman, sir, and all other respected dignitaries and participants. I'm just offering my congratulations here. Is it visible, sir?
Yeah, visible.
So I'll be discussing impact on pharmaceutical sector, pandemic and after. And the flow of discussion will be Indian pharma market in pre-COVID condition, current scenario of pharma market, impact of COVID-19 on pharma market, role of China in API, that is raw materials, step to strengthen domestic production of API, expected change in buying behavior will boost the domestic market, healthcare market as an upcoming package, and conclusion, that is journey to a new orbit. Now coming to the first point, Indian pharma market in pre-COVID conditions, sir. The Indian pharma industry has a CAGR of more than 15% over the last 5 years with significant growth opportunities. India is known as the pharmacy of the world as it consumes 20% of the world generics and 60% of the total vaccines in the world market. It is indeed a matter of pride for us that India caters 40 to 70% of the WHO demands for the vaccines. In 1969, Indian pharmaceutical had a 5% share of the market in India, that is domestic market, and global pharma had a 95% share. By 2020, it was just the reverse, with Indian pharma having an almost 85% share and global 15%. Over the last 50 plus years, in terms of both meeting the domestic needs as well as the building a leading position in the global pharmaceutical landscape. India's domestic pharmaceutical market turnover reaches 1.4 lakh crore in 2019 as compared to 1.29 in 2018. Now, current scenario of pharma market, that's the impact of COVID-19 on pharma market. Indian pharmaceutical market comprises of companies that sell drugs for acute ailments, approximate 47% in domestic market, are expected to witness a decline in earning, while those with a significant exposure to the chronic portfolio, such as cardiac and diabetic, there is a chronic part. Such therapies accounts 33% of Indian pharmaceutical market, that is domestic market, may be spared in the first full quarter affected by the coronavirus pandemic. In other segments like immunity enhancer, wellness formulation have a good jump during this period. Several brands have already been launched in this period. And physicians shut clinic for most of the Q1 amid the lockdown, and a decline in elective surgeries that are scheduled in advance at hospital led to a drop in sales of injectable, according to Nirmal Securities. That is said either cost part of the demand get postponed or permanently lost, impacting the acute segment therapies for severe but short duration illness. Now, role of China in API. This is very much important to know that API is a raw material which you are normally using in pharmaceuticals. Although India manufactures 1/3 of the global supply of medicines, over 80% of the raw materials needed for the drug are imported from China. This gives our neighbor a virtual monopoly over supply and pricing, to the point that there are no domestic producers for most medicines in India. The total import of drug intermediates and bulk drugs exceeds 25,000 crore, and China accounts for over 70% of it. Considering India's heavy dependence on imports, policies formulated by central government to give more agencies to indigenous manufacturers. India has also significantly increased the import of antibiotics from China in the recent years, and the trade is currently worth billions of dollars. If China decided to pull the plug on the supply, it will lead to a huge public health crisis in India. Drug companies claim that low-cost imports have forced a lot of manufacturers to shut the shop. A number of them have given up manufacturing ingredients for the other drug makers and have started manufacturing complex formulation on their own. These are then exported to developed markets in first world countries. Difficulties in obtaining environmental cleanliness and red tape have made it quite uneconomical to manufacture raw material indigenously. Today, in global API market, China is the undisputed leader as volume-wise China produces approx 20% of the world's API production. China manufactures more than 2,000 APIs and exports them. According to the PharmaAxle report, China exports API to nearly 189 countries, which are mainly from Asia, Europe, and North America. Now, steps to strengthen domestic production of API. Considering India's heavy dependence on import, policies formulated by the central government to give more agencies to indigenous manufacture have only remained in paper, though the process started earlier also. Now, however, it is not too late to start mass production raw materials. The pandemic presents us with the opportunity to turn things around the government support. With the coronavirus outbreak, restricting import from China, the government has taken steps to ensure that there is a sufficient supply of medicines by limiting export of 26 APIs and medicines, which accounts for 10% of the pharmaceutical exports. It would have no doubt affect the availability of these drugs in countries that depends on both India and China. Due to ongoing pandemic, DGFT on 3rd March 2020 made changes in their export policy and they banned several formulations. Later on 25th March 2020, again the export policy was changed and the wonder drug hydrochloroquine, which is considered as a treatment of COVID-19, was included in this list. As all this was done before, because the API which is used in the manufacturing of this formulation is imported from global market, especially from China, and due to COVID-19, the import of this API was badly affected as this API was in short supply. Now, expected change in buying behavior which will boost the domestic market. Now, during this period, as an effect of COVID-19 situation, this is expected to have a medical budget in the day-to-day expenses. It is a matter of discussion in middle class and above, which is will boost pharma market. As the tendency of health insurance increasing will boost the pharma market. Telemedicine is another alternative which is increasing day by day. Online pharmacy and immunity enhancer products. Now,
Mr. Shah, please complete within 1 or 2 minutes.
Okay, sure. A healthcare market as a complete package. This is a new terminology coming up. Healthcare market is a combination of pharmaceuticals, hospital care, diagnostic, healthcare insurance, mobile apps like Pacto, Apollo, etc. It has been observed that during this period, COVID-19, several design package being offered by the several corporate hospital, diagnostics, mobile apps, health insurance company, etc. Now, Ayushman Bharat is another part. This is a matter of discussion. Now, in conclusion, there is a journey to a new orbit in spite of within increase the global connectivity. An acute epidemic was just a matter of time. We could have followed the advice of epidemiologists and taken preventive measures to avoid a pandemic, and yet here we are struggling to contain a public health crisis, which ensures that the economy doesn't get destabilized. However, we need to swallow the bitter pill and acknowledge the long-term impact on the pandemic is going to have to an economy. The COVID-19 crisis provides an opportunity to us Indian pharmaceutical industry to play an even more important role in global market. There is a potential opportunity for India to truly play the role of pharmacy in the world. Though COVID-19 has shown an instability in pharma sales in last few months, but it is a matter of few days. It expected the pharma market will come back in normalcy very soon, which we have seen in the second quarter also. The whole world is waiting for the vaccine for COVID-19. Definitely it will have the impact on sharp rise in socio-economic factors and obviously in pharma market. Thank you so much.
Thank you, Mr. Shah. So now let us move to the paper authored by Ms. Sneha Ghosh and Dr. Manoj Nashkar. So Sneha, please start your presentation. Sneha, can you hear us? Sneha, please start your presentation. Or other. Should we move? Sneha, can you hear us? Or should we move to the next paper presenter?
Sneha is not visible, I think, on the platform. Her name is not visible.
No, just a few minutes back, she was there.
Okay.
Okay, so let us move to the next paper presenter. At the end,
Yes.
if she can join, then we'll give the chance. So should we move to the next paper presenter?
Yes, sir.
Okay, and then I request Mr. Saurabh Pal to give the presentation of their
Yes,
paper
sir.
jointly authored by Sharnava Das and Mr. Saurabh Pal.
Sir, am I audible, sir?
Yeah, absolutely audible.
Yes.
Good afternoon, sir. Good
Good
afternoon to
afternoon.
all the processors and my fellow mates.
So please
uh,
make yourself visible. First, make yourself visible.
Sir, I am opening the screen share.
Can't see the screen.
Why is he not responding?
Saurabh?
Yes, sir. Yes, sir. So, sir, my screen is visible to everyone?
Yeah.
Yes, yes.
Okay. Okay, sir. Good afternoon to all the professors and my fellow mates present here. So thank you so much for giving me the opportunity to present my presentation entitled Impact of COVID-19 on Organized Pharmaceutical Sector in India. So now coming to the introduction part. In December 2019, the novel coronavirus, that is COVID-19, was discovered and identified in Wuhan, China. On March 11, 2020, the COVID-19 outbreak was declared as a global pandemic by the World Health Organization, in short, WHO. Subsequently, in the following months, COVID-19 rapidly spread around the globe and infected about more than 2.5 million people by April 23, 2020. The COVID-19 pandemic affected world economies, including the pharmaceutical sector. So while currently there is no definitive treatment for this novel infectious disease, pharmaceutical industry is assisting governments to address the COVID-19 unmet needs, from research and development actions on potential treatment strategies to balance medicine supply chain in the time of crisis. So along these, pharmaceutical sectors are struggling to maintain the natural flow as the recent pandemic affects access to essential medicines at an affordable price, which is the main goal of every pharmaceutical system. So according to Mr. Srikant Kumar Jena, the Minister of State of Chemicals and Fertilizers, Government of India, the Indian pharmaceutical sector is the third largest in terms of volume, and it ranked 14th in terms of value. It ranked 4th in terms of generic production, and finally 17th in terms of export value in the world. So the Indian pharmaceutical sector or market stood at rupees 1.3 lakh crore, 19.89 billion USD dollar as on November 2019. So now the organized pharmaceutical sector in India manufactures almost 60% of the vaccines used globally, including important ones, such as those against diphtheria, tetanus, and pertussis. Here pertussis means the whooping cough required by the World Health Organization. Furthermore, India meets 90% of the global demand for vaccine against measles. Millions across the world use generic drug products by Indian drug manufacturers. More than 250 factories in the country have been approved by the US Food and Drug Administration, in short FDA, as well as the UK Medicine and Healthcare Products Regulatory Agency, according to Express Pharma News Bureau on 23rd May 2020. These manufacture drugs for overseas market like United Kingdom, South Africa, Russia, and Nigeria. This is according to the Forecasting and Assessment Council, an autonomous organization under the Department of Science and Technology, Government of India. So in the early 90s, India was among the leading producers in active pharmaceutical ingredients, that is, in short, API category, but over a period of time, due to many changes in the manufacturing policies and regulations with decreasing margins and stringent environmental norms, the Indian pharmaceutical manufacturers converted themselves from the active pharmaceutical ingredients manufacturing, and it resulted in the closure of many pharmaceutical companies, whereas during the same period China strengthened itself in the active pharmaceutical ingredients, that is API manufacturing sector. Now the result is that India unfortunately imports more than 70% of the active pharmaceutical ingredients, that is API, and key starting materials, in short, that is KSM, from China. India actually imported rupees 17,400 crore worth of APIs from China in financial year 2019, according to Times New Network on 19 June 2020. So, although the organized pharmaceutical sector in India is an important component of the global healthcare infrastructure and is instrumental in saving millions of lives every year, it too has also been affected by COVID-19 due to economic uncertainties and various business challenges. So now coming to the objectives. So our intention was to identify the various impacts of the pandemic on organized pharmaceutical sector in India. This article has proposed also few possible strategies in this regard that can be taken up by the pharmaceutical sector in India and the government to overcome the crisis and keep the situation under control. The information relating to the impact of COVID-19 on organized pharmaceutical sector in India has been collected through internet and print media, like some of the e-business magazines and e-newspapers. So now coming to the main portion of my presentation, that is the impacts of, or the various negative impacts of COVID-19 on organized pharmaceutical sector. So the first impact is shortage of supply of active pharmaceutical ingredients, that is the APIs or finished drugs products from China. So under this, the pharmaceutical companies of India face disruptions due to extended factory closures in China due to coronavirus fears, accounts for a majority of raw ingredients used to manufacture finished goods. So according to the India's Drug Regulatory Authority, 57 antibiotics, vitamins and hormones, or rather steroids, had a chance to go out of stock in case of a prolonged lockdown in China. So the outbreak of COVID-19 caused potential disruptions to supply critical medical products also. Now to the second point, rising of price of drugs. So due to lockdowns,
please complete your presentation within 2 minutes.
Okay, sir. So rising of price of drugs due to lockdown and closure slowed production of APIs, resulting in less availability and higher cost of materials required to generic production, and finally raise the prices of key ingredients. Now the inter-transport challenge. So inter-transport challenge was also a major issue. There are a lot of medicine stock that comes from Goa and Baddi. Baddi is a small town in Himachal Pradesh and Sikkim and distributed to various regions of across India. So now the impacts on export of drugs. India has been meeting more than 20% of the world and almost 50% of US generic drug requirements. So due to this lockdown, all Indian pharmaceutical facility can sell drugs in US only after it has been inspected and approved by the US FDA. So with the ban on international travel, inspection is naturally not possible. So now to the new launches to fall. As the movement of people and goods restricted amidst lockdown, manufacturers of generic drugs are unable to launch new products. Now to the shift of communication and promotions to remote interaction through telecommunication and telehealth. Due to social distancing precautions in both global and local levels, marketing and promotions of healthcare products is impossible. And now face-to-face interaction towards remote interaction and telecommunication, both promotional and patent support acts. This has been adverse impact on new prescription generation and prescription swapping because of patient inability to meet doctors. Now this is the growth trends of pharmaceutical market in India. So from this table, we can predict that the volume growth of pharmaceutical sector in India were 5%, 4% and 4% in the years 2017, 18 and respectively. So from this table, we can conclude that new product launch, price growth, a new product launch has decreased, price growth has increased, and volume growth has decreased to negative. So now my proposed strategies is that the pharmaceutical sector in India should create a culture of blue sky. That means possibility thinking. That means they should go for new business ideas. Now to the second point, the pharmaceutical sector in India should conduct a strong operational orientation. And according to that, they should execute the plans based on decision making and analytics. Now coming to the third point, the pharmaceutical sector in India should create robust empirical platform so that it can quickly detect and measure the existence and potential effects of unexpected and avoidable if occur. Now the pharmaceutical sector of the business with a proper infrastructure equipped with well-organized machineries and technologies and skilled human resource and scientists. And now the big pharma companies should go for the small pharma companies. This should be beneficial for both of them. Now the central government and as well as the state government has taken much more initiative